Today we are talking about double entry system. Sometime back, there's a gentleman asking a question. Why the balance sheet should tally? Is there a balance sheet? Now, you people always struggle, the accountants, the accounting teachers always struggle, accounting students always struggle to tally the balance sheet. You try to match the balance sheet. Why the balance sheet should match or tally is the question. The answer is simple. It is because of this double entry system. Oh, that's also too technical. Can you simplify it in a layman's language? I'm a common man. Can you simplify to us why the balance sheet should tally? If you simply say double entry system rule, then we don't understand what is that. Again, we had to open the books of accounting. Can you make it even simpler? It is as simple as this. You cannot spend more money what you have in your pocket. You may say that, I can borrow from my friend. Yes, you borrow from your friend, and when you borrow, it comes first to your pocket and only out of pocket you will spend. I said very clearly and categorically that you cannot spend more than what you have in your pocket. What you have, I said. It is not that I have not restricted you from borrowing. I didn't say that your own money. I didn't say any rules and regulations there. I simply said you cannot spend more than what you have, or what you have in your pocket, what you have in your cash box. That's a rule applied. That's the reason that balance sheet should tally. Now let us look in detail about what it means when I said. There's an accounting cycle, just as I told you in the previous session. Accounting is the process of recording, classifying, analyzing, interpreting, summarizing, interpreting the financial results. That is the definition. Now, when you see that, there is a process. The process has a cycle. It starts with recording and it ends with interpretation. Now, here there are 7 windows presented to you. There is a preliminary or first step taking place in accounting. Whenever there is a transaction happens, you identify it and record it. When you record, you classify what you have recorded. How do you classify? When we take the food, we don't take the food based on, this is vitamin A and this is vitamin C and this is vitamin D and this is protein and so forth. We don't take individual items. As we come across food, or as and when we are hungry, we just keep dumping whatever comes, whatever is available, whatever comes away, not assessing whether this food contains vitamin D or contains vitamin E or contains vitamin C. We don't bother. Something that is tasty, our tummy yearns for it. So we keep dumping, we keep eating whatever is available or placed in our plate. Just like that, the accountant, whatever, wherever in the organization, whatever information related particularly to the finance, any word suffixed or prefixed with rupees or dollar. Remember, we record in financial data, we record things in financial data, or only monetary related monetary related transactions are recorded. There is a misunderstanding between or among a group of employees. That is nothing to do with finance, or there is no monetary value carrying. That may have the effect on your business operations, but that doesn't carry, those things do not carry any monetary value. As long as you cannot convert that into money value or dollar value or rupee value, you cannot record in the books of accounts. So therefore, only that transaction which carries monetary value you are recording. Now, while recording, you just record just like that. As the transactions come, you keep dumping in the books. There's a book called Journal, and this book is known as Book of Original Entry. This journal records, irrespective of whether it is related to asset or liability, related to expense or income, related to cash or credit, related to this month or next month, for an accounting period, every transaction which carries monetary value is recorded there. When you are recording, it's very difficult for you to identify which category of transactions these are belonging. So, you will open another book called, be it digital book or manual book or hard copies, you open another book called Ledger. First book is Book of Original Entry, and you open another book called Ledger. A ledger is a book containing several accounts. You have plant and machinery, open an account for that. You have inventory, open an account for that. You have debtors, the credit customers who have not paid money for the sales you have made. You open an account for that. You might have bought some goods from your customers, your suppliers of materials. Open an account for that, creditors accounts. And you are selling numerous times in a day your goods or services. Open an account for that, sales account. So you are purchasing, open an account. You are selling, open an account. Anything that you say that you carry on repeatedly, there are so many times you pay cash, so many times you receive cash, open a cash account. So if you are opening accounts and every time you come across a cash transaction, you dump into cash account. Every time you come across a credit purchase, you dump into creditors account. Every time you come across a credit sale, you dump into debtors account. Every time you come across sales, you write in sales. Okay. Now, this is how you segregate, categorize the transactions into various accounts. These various accounts are presented in a book called Ledger. Now, the ledger accounts, let's say, for convenience sake, I'm just telling you, a ledger account may have 3-4 leaves in the book or 10 leaves in the book, each account. But for convenience sake, if for each account is one page, if you are earmarking, at the end of the accounting period, now look at this, at the end of the accounting period, when I say the period may be a quarter or a half year or 12 months, not beyond generally 12 months. Why there should be a period, a quarter or half year or an year? It is because you have to check back whether you are doing well or not. There should be a starting point of time, there should be an ending point. In between what happened, you have to check and examine your performance. Fine. So, for a given period of time, you record all the credit purchases in a creditor's book or creditor's account. Now, at the end, you will have to make out what is the total of the creditor's amount. Likewise, you record in a day so many times, likewise thousands of times in a month, and in a year lakhs of times you are selling. All those lakhs of times transactions you have to summarize and say this is the sales balance, the sales account balance, the purchases account balance, the creditors account balance, the cash account balance. At the end of the accounting period, you make a summary. Let's say there is a balance, right? There is a balance. Now, when you're preparing the account, you had to follow a system that I will deal with in your next slide. Now, I'm trying to say, for a synthesis of the transactions into accounts, you had to prepare a book called Ledger. From the ledger, you're taking the summary. At the end of the account, you're taking the summary. Pick up the summary of all these accounts and put it in a statement. That statement, you're calling it as trial balance. Trial balance. All the balances of the accounts you're presenting in another statement called trial balance. Now, from trial balance, we prepare two major statements called income statement, which presents profit or loss, balance sheet, which presents liabilities and assets. So, once we prepare the liabilities and assets, by checking the opening and closing entries, or if there are any additional information while preparing the balance sheet and profit and loss account, in addition to what is presented in trial balance, there may be some notes, at the time of preparation, some additions may be there. Those things also are incorporated. Finally, financial statements are prepared. What are they? Income statement and balance sheet. Once the balance sheet is over, you're saying that the accounts for this financial year are closed. When it is closed, what next? You will jump into another financial year or accounting year. Now, in India, the financial year starts from the first day of the March and ends on the 31st day of the next year. First day of April this year to the 31st day of March of next year. 12-month span is financial year, and we are preparing financial statements for 12 months. The entire process, what happens in this in between, is accounting cycle. Now, while preparing, I have already presented before you few things, and then I want to present most important principles. You call it generally accepted accounting principles. I am not going to take all of them, but few of them which are important to prepare financial accounting, I am presenting before you. Now, accrual principle. Accrued means becoming due in accounting parlance. Once the expense becomes due, whether paid or not, you record. Employees have worked for the entire month. You might have not paid because there is no cash available in the account, but you will write on the last day salaries. You have to account whether paid or not. It is becoming due at the time of recording the business transaction. Likewise, incomes also are recorded whether received or not. Once they become due, they have to be recorded. Once they become due. Accrued means becoming due, whether received or not, whether paid or not. Once they become due, you have to record. Consistency, I have already explained to you, but just a recap. You have to apply the same accounting principle across or all the years, so that you make them comparable, you make them understandable, whoever is reading those accounting statements. Now, you have also going concern concept. What is this going concern principle? You prepare the accounts or books of accounts in such a way that the company exists into perpetuity. What is that? You're not preparing as if the company is going to be there for 10 years or 15 years or 20 years. You set up the company with a motive that it should run forever into perpetuity. So, going concern principle says that you are preparing as if the corporate is operating indefinitely, forever. Now, you have conservatism also. What is this conservatism? Conservatism is, anticipate all the losses. Whatever loss you foresee, you try to incorporate, but don't anticipate the gains or profits. Let's say if you think that the stock material prices may go up, incorporate the price rise in the materials in valuation of your inventory or stock. But if there is a possible fall in the price of inventory in the market, don't record that. Any possible gain you are witnessing in the market, no need to recognize that. But if there is a possible loss, please incorporate that. That's the principle of conservatism. When you're preparing accounts, you have to prepare accounts in such manner. Now you have materiality. What is materiality? Now you have barter price. What is that? 1999.95 paise. Okay, that's a price given. Is it, it sounds as if it is 1000 plus, but actually it is 5 paise less 2000 rupees. So when it is, when you are trying to arrive at a figure like that, round it off to the next accounting figure, round it off to the next near money term. So and also you need not record insignificant things like, there is an alpin, there is a small eraser, or small sharpener or a pencil. These are negligible in value, maybe half a rupee or 1 rupee or 5 rupees. When you are a company running in billions of dollars, and writing these things individually is, very voluminous. So therefore, one simple word you can use is stationary purchase. The eraser, sharpener, alpins, stapler, everything falls in that category. Simply write stationary. Okay, so this is materiality principle. Now, yeah, you have, now we are jumping into the core of debit and credit. Every financial transaction has equal and opposite effect. At least two different accounts. What? If there is a giver, there is a receiver of a benefit. If there is a benefit giver and there is a receiver. Let's say when you look at a beggar at the street, you are ready to give, but there is nobody to take. Then your arms are not perfect or fulfilled, because you are ready to give, but there is nobody ready to take. Or there are people ready to take, but there are no givers. It is not fulfilled. The donation, the charity is not being fulfilled. So in accounting, if one account is giving benefit, there is another account takes benefit. There is a receiver of benefit, there is the giver of the benefit. Okay, now let me just present the debit and credit. Very often people ask you what is debit and what is credit. There is no difficulty, it is as simple as this. Debit means simply write on the debit side, and credit means write on the credit side. As simple as that, there is no technical jargons behind that. So when do you debit it? When do you credit it? When a benefit is received, you debit. When a benefit is given, you credit. The account that receives the benefit has to be debited. The account that is receiving benefit has to be debited. The account that is giving benefit has to be credited. The account giving benefit has to be credited. Account receiving benefit has to be debited. This is to be borne in mind of the student who is preparing the books of accounts. Now, accounting equation. Accounting equation. Assets is equal to liabilities plus equity. If it is a not-for-profit organization, then you are placing this equity is known as net assets. If it is a not-for-profit organization, this is called net assets. So assets is equal to liabilities plus equity. Equity means equity shareholders. Now, importance of financial accounting. How do you say that financial accounting records are very important? Now, as I told you, they are very important in making decisions, regulatory compliance, accountability, all this stuff. Now, you have to analyze the books of accounts, and for that you need ratios. Okay, and look at this, the double entry bookkeeping system. If you maintain, you need to calculate the ratios. From the profit and loss account, you prepare the ratios. Okay, you have the profit and loss account ratios are gross profit ratio, net profit ratio, and when you look at the balance sheet ratios, liquidity ratio, solvency ratio, and other efficiency ratios. Like, we will come back to double entry system. Having prepared the accounts and having prepared the summarization, that is trial balance, and having prepared the books of accounts, the summary of the financial accounting, like income statement and balance sheet, we have one more statement called cash flow statement. Generally, it is supplemented to income statement and balance sheet. Now, for some time back, this cash flow statement was not part of these financial statements, but lately, very recently, cash flow statement also is attached to profit and loss account or income statement and balance sheet. For the reason, income statement and balance sheet are not presenting the cash position of the organization. Why they are not presenting the cash position of the organization? Because they are following one rule called accrual. The first rule, they are following accrual principle or accrual concept, and because of this accrual concept, the financial statements presented in the financial statements presented in the annual report are not giving the clear picture of the cash position. What do I mean to say? There may be a huge profit in the organization, but there is no cash available. Why? You are supposed to receive dues from your credit customers called debtors. You have so much of credit sales. So because of that, your profit is shown more. But what is a cash available? Cash available is very negligible. So to know whether there is any cash available or not, we prepare another statement called cash flow statement. The cash flow statement presents three areas. One is cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. Cash flows from operating activities we derive from the profit and loss account. And how do you get it? You take the net profit and adjust the current assets and current liabilities and also non-cash items. Okay, you get the cash operating profit. Then you have cash flows from investing activities. Cash flows from investing activities arise out of purchase of assets or sale of asset. Purchase an asset of sale. When you buy the asset, cash goes out. When you sell the asset, cash comes in. So the net effect can be cash came in or cash goes out. Right? There's an outflow of cash, there's an inflow of cash, the net result. Likewise, you have financing activities. When you raise the equity shares, you raise money from the market. And likewise, when you raise debentures, you raise money from the market. And that money is cash inflow. When you are paying back the loan or when you are redeeming or paying back on the debentures, cash goes out. So the cash outflow, cash inflow, net effect can be cash outflow or inflow. So three areas are taken: cash flows from financing activities, cash flows from investing activities, cash flows from operating activities. So this is another statement supplemented to balance sheet and profit and loss account. Now you will find more of these in your study material supplied to you. There is a systematic way of writing the journal entries. You had to practice as much as possible from your study material writing the journal entries. When you are perfect in writing the journal entries, then it is easy for you to segregate into ledger accounts. When you are segregating properly into ledger accounts, it is easy for you to summarize in the trial balance. When you are able to tally the trial balance, then you are able to prepare the profit and loss account and balance sheet. When you can prepare these two, you can prepare the cash flow statement also. We have seen now the income statement and balance sheet and also cash flow statement. There is one more statement which is often not supplemented in the annual reports, and these days many multinational corporations are supplementing the statement of changes in financial position. Okay, that is called funds flow statement. Funds flow statement, how the funds are flowing into the organization, flowing out of the organization. It is not the cash we are talking about, it is the fund. How the funds are coming in, how the funds are going out. There are three segments again. Funds from operations. Funds from operations we calculate with the help of the profit from the income statement and the current asset and current liabilities of the balance sheet. Funds inflows and outflows. Whenever there is an asset sold, we are not categorizing just in case of cash flow statement under accounting under section 3 of the Companies Act we prepare. We are not making segregation. There is no requirement as per the Companies Act 2013, but when it comes to funds flow statement, it is just writing the inflows under a list called sources whenever there is a inflow, and writing the outflows under this list called application. Sources and applications are the two lists. The sources are presented on the left side and applications are presented on the right side. The funds from operation is part of the sources of the fund. Now, what are the other sources? When there is an asset sold, the fund comes in right under the source. When there is a loan raised, there is a fund coming in right under the list of sources. When you are raising a bond, fund comes in right under the list of sources. And likewise, when we look at the application, whenever there is a purchase of asset, then you have to treat it as fund going out right in the application, fund applied. Whenever you are repaying the bonds, money goes out, fund goes out right in the list of applications. And likewise, you have adjustment of the working capital. How do you adjust the working capital? The working capital is adjusted. The working capital is adjusted with increase or decrease. How? When there is an increase of the working capital, when there is an increase in the current assets, it means you bought the material, fund goes out. When you are selling the material, fund comes in. So, increase in current asset is treated as outflow, decrease in current asset is treated as inflow. Similarly, current liabilities, increase is treated as inflow and decrease in current liability is treated as outflow. Whatever it is, there is a net change in the working capital. This net change in the working capital is adjusted and presented. If there is an increase in net working capital, you are presenting under the sources. If there is a decrease in working capital, you are presenting under the list of applications. So, with this, your funds flow statement gets tallied. Your funds flow statement gets tallied. Funds flow statement is just like other statements, is one of the statements of changes in financial. Just like cash flow statement, funds flow statement also is one of the statements of changes in financial position. In addition to income statement and balance sheet, you prepare cash flow statement and funds flow statement also. These are presented in your annual report. Thank you.